Hi there, hello everyone. Today I'm going to present before you as part of Fundamental Analysis series. What is the trading strategy for economic indicators data? So when we have different kind of economic indicators and when the data comes out in the market on a monthly basis, then what should we do? How should we trade those economic indicators data when they are in the market? So let's see what we have. Okay, so first of all, we need to understand in forex markets or in forex trading, we have two types of analysis. The first one is fundamental analysis, and forex markets actually move on fundamentals, and changes in fundamental lead to change in the technical analysis. So, what is technical analysis? The price movements you see or we see on the price charts in your trading platform are primarily due to fundamentals, okay? And that's what we believe in, that all those input to the technical analysis price movements actually are or they come from fundamental analysis. So fundamental analysis is of utmost importance. So what is actually fundamental analysis? Fundamental analysis consists of each country's monetary policy, economic conditions, and the overall value of their currency. So this is how we look at the fundamental analysis: monetary policy, fiscal policy, economic policies, and the overall strength and condition of that currency, of that country's currency. Okay, so what happens that we study fundamental analysis? So there are different economic indicators that we study and look at the data that when it comes out in the market, the updated data usually on a monthly basis. So actually we are talking about US based economic indicators. So whatever you see on this picture on this screen, they all related to economic indicators related to the US market. So we have consumer price index, we have non-farm payroll, producer price index, University of Michigan consumer sentiment, and conference board consumer confidence. And then core PCE price index, PCE is personal consumption expenditure, then how much money somebody or an individual spends each month. And then we have average hourly earnings, how much people earn. Then we have job openings, that how many jobs are there in the market, unemployment rate, core retail sales. And then we have interest rate, that how the central banks of each current country, they play with their interest rate to control the overall supply of the money. And then we have federal fund rate, Empire State Manufacturing Index, ISM Manufacturing PMI, and then ISM Services PMI. PMI is your Purchasing Managers Index, and Flash Manufacturing PMI, and then we have Flash Services PMI, ADP Non-Farm Employment Change, Jobless Claims, and then we have Employment Cost Index, and we may have few more. So this is basically all the uh, list of economic indicators that the data about each indicator comes in the market at different times, and then we see what that data is about. If the actual is greater than forecast or actual is smaller than forecast, then accordingly we look at that data, analyze it, and see how it will impact the forex market. So what should be the trading strategies and how to trade? So when the data comes out in the market, so definitely there will be a high volatility. So some traders take a position in the markets around the data release, as the data has historically been known to cause sudden price movements up or down in the market. And traders, either they can trade into profit or they can trade into losses. It all depends on their trading strategy and how they analyze the economic indicator data. Okay, so what could be the possible trading strategies? Scenario one, trading on sharp moves. So when happens sharp moves in the financial markets, both up and down. So you never trade on sharp moves. We also call it knee-jerk reaction. So try to avoid and definitely avoid trading on sharp moves. We will see in the next slide what does that mean, trading on sharp moves. So scenario two, fade the initial reaction. So when there is a sharp move, so fading the initial reaction involves that one should wait for the initial movement of the price up or down to come back to its normal position. So you just got to see the initial reaction and then let it fade. And then in scenario 3 we have a pullback strategy, and this approach is where the price has moved sharply up and down and then reverses its direction and wait for the pullback and then take a position. Okay, so first you will wait for the initial reaction to fade, and then you will see if the price reverses, and it reverses its direction, and then wait for the pullback, and then you can take a position. So this is how actually you look at the economic indicator data and then look at these three scenarios to develop your strategy. Okay, so let's see when the data comes out in the market, what happens. So what is the bearish scenario? So for example, this is an upward market, the price is moving up, and then over here this is the current market price, and highly likely there is a news break as well. Okay, so there is a news break and the price suddenly spikes down based on the data of that indicator. It may be like actual smaller than the forecast, and it's bad for the currency, so we assume that price spikes down. So here it is spikes down. Okay, then it reverses its direction a little bit and goes up again, and then it pulls back around 45 to 50%. Okay, and then this is where we will take the position sales, and then from there it will pull back over here, it will pull back over here, and then we will take a position over here. So this is how you actually take a position on an economic indicator data when it goes into a bearish scenario. So over here this long bar, when it spikes down, you do not trade on this spike. Okay, never trade on this spike. Now let's look at the bullish scenario. Okay, the price is going down, and then here the current market price and news break, and then the news breaks and price spikes up. Okay, just like this here. Okay, and then do not trade this spike. Okay, let it happen, let it happen and cool down. And then what happens, the price reverses back, comes back here, and then pulls back around 45 to 50% here from its original spike, and then you can take a position over here, and from there you take a buy position, and then it pulls back, tested a level, and then it goes up again. So this is how you can look at two different scenarios, bearish scenario and bullish scenario, whenever there is a news break in terms of economic indicators. Okay, so what happens? Trading strategies we discuss. Okay, it can create volatility, either profit or loss. Then the volatility involved around data release may deliver large short-term profits and greater short-term losses as well. Okay, so when that happens, you have to have your risk management strategy in place. So it's therefore very important to pay attention to your risk management approach, and when you have that, you have to have your risk management action plan in place as well, so that risk management enables you to close the position if the view proves to be incorrect. So if something does not go right, you have to have your risk management action plan in place, and then you are able to close out your position. So this is how we actually look at economic indicators data when it comes out in the market. We see how it moves, how the news makes a spike upward or downward, and on the basis of that we develop our trading strategy, and along with that we also do our risk management and risk management action plan. Alright guys, I will stop here. I hope you like the video. I will see you next time. Have a good day. Bye bye.